today is inventory concepts. We have several different areas to look at, several different topics, so let's kind of just jump right in. First thing let's look at is if you're a merchandising firm. Right? If you're a merchandiser, then you purchase a finished product, you mark it up, and you resell it. So you're not making anything, but you do have physical, tangible products that you're selling. So you do have inventory. You purchase them, you put them on your shelves, you have them in a warehouse, you hope to sell them soon and make a profit. So on your balance sheet, you're going to have an asset called merchandise inventory. And it will be valued or reported at the cost at which you paid for it. Hopefully, again, you're going to sell it for more than you paid for it because you want a profit. That'd be the whole point. But you're going to see that one new asset account listed if you're a merchandiser. If you're a manufacturing firm, though, then you actually make your own product. Okay, so you don't just have one account now. You're actually going to have 3 different inventory accounts if you're a manufacturing firm. You would have a materials account for the actual raw materials, the things that you're going to make into a product. Once you start working on your product, you're going to put those materials into an account called work in process. You're going to apply labor to them, you're going to have some overhead, you might, lights in your factory building, some other types of things. I don't want to get too detailed with it, just lay some groundwork. And you're going to work on that. Well, once you've actually completed and finished your products, you've made something entirely, it's done, then you move that out of that work in process inventory and it goes to a finished goods inventory. So manufacturing firm, you'll find 3 inventory accounts on their balance sheet, not one. You'll have materials inventory, sometimes you'll see it as raw materials inventory, work in process inventory, and finished goods inventory. You'll see a lot more about manufacturing side when we get into accounting 2 or into more of the managerial accounting side. Goods in transit. When we're trying to make sure that we have all of our inventory accounted for at the end of a period, we need to consider what about those goods that they're not quite to us yet, right? So we have some goods that are in transit. Well, depends on which shipping terms they're under. We've discussed shipping terms before, FOB shipping point and FOB destination. If it's FOB shipping point, remember it's free on board to the buyer until it reaches the shipping point, the place in which it needs to leave. So if that's the case, remember we talked about when title passes. Title or ownership will pass at the shipping point. So the buyer will own those goods when they have left the shipping point. So if you ordered something for inventory and it has not reached you yet, should it be included? Well, if it's been shipped and it's FOB shipping point, yes, it should be included because technically you own it already. But if it's FOB destination, title does not pass until it reaches the destination. So if that's the case and you have not received the goods yet, then they should not be included in your inventory because the title has not passed. You do not own them yet. So those are important things to understand when you're trying to figure out if you should count some items in inventory or not, and also making sure that you do count items that should be included. Another concept that deals with that same topic is consigned goods. Should they be included? Should they not? Well, consigned goods are items that you have, well, we can look at consigned goods either way. If you have consigned goods, those are items that you don't own, but you have physically in your location that say you're trying to sell. Sometimes stores have displays that are set up and they're actually not owned by them. A company sets up a display and puts products on it. The company still owns the products, but they're taking up store space to sell. When they sell, then some of that sale goes to the store that housed them, but they're not owned by the store at any point in time. Or you could talk about goods that you might have consigned. What if you had put some of your product in a store? It's still owned by you. Okay, it's not owned by the store. So you have to be careful. If you have consigned goods on your premises, they're not yours. They don't need to be included in your inventory count. But if you have goods that are yours that you've put on consignment at another place, okay, then you need to make sure those are still included in your inventory because you still own them. You've just put them in a store, for instance, to sell somewhere. So you have to make sure you understand that topic of consigned goods, whether to include or not to include those goods in your inventory counts. Cost flow assumptions. We said that your inventory is going to be on your balance sheet at the cost you paid for it. Well, how do we account for cost? There are 4 types of cost flow assumptions: specific identification, FIFO, LIFO, and average cost. Specific identification is used when you can specifically identify what that one product cost you. So if I could go pull a product off a shelf and say I know exactly how much this cost me, this one individual item, then you could use specific identification. I always think of jewelry stores for specific identification. I'm sure they could tell me exactly how much that diamond cost them. That diamond's different than the diamond next to it. They don't buy all identical items. So they could probably use specific identification. For places that's not really the best policy necessarily, or that would be more difficult or time consuming or costly, then you can use FIFO, LIFO, or average cost. FIFO and LIFO stand for, FIFO stands for first in, first out. LIFO stands for last in, first out. This tells me the order in which items are sold. So if we're under the cost flow assumption of FIFO, the first items of inventory that I purchased that were in my inventory will be the first ones that I sell. So it approximates a physical flow of goods. The first ones in the store, I assume, are the first ones that go out the door with the buyer. Okay? So that's how I'll account for the cost. So when I'm looking at cost of goods sold, that would be involving those earliest items that were in inventory. But if I'm talking about ending inventory, that'll be what's left over, the most recent items. LIFO is the opposite. LIFO stands for last in, first out. So again, it's still the order of sales, but now the last ones or the most recent purchases or items that have been added to inventory, I assume are the first ones that are sold out. So that would be your cost of goods sold. Ending inventory then are the oldest purchases, the things that you had first in inventory. You assume they're still there, so the costs associated with those would be included in ending inventory. Average kind of falls in between both FIFO and LIFO. What you're going to do with average cost is literally get an average for all items in inventory, whether they're old or new or in between, and you use one average to account for the cost of both cost of goods sold and ending inventory. Now, I'll give you some specific examples of these. I'm not going to give you numbers right now, but you can look for my examples that have a walkthrough with numbers so you know exactly how this works. And again, we can do these under both a perpetual system and a periodic. So remember, perpetual is the system that every time something happens, we update inventory. We always know what our cost of goods sold is. We always know what the inventory figure is. When we purchase something, we update inventory. When we sell something, we update inventory. So we always know those figures under a perpetual. Periodic is where we're going to wait, and we're not going to update it every time. We're just going to wait periodically and then update it. Say at the end of the year, we take that physical count, we compare it to our records, and then we calculate cost of goods sold and determine what our ending inventory figure is. Okay? But both of those, we can utilize these cost flow assumptions. It will be a little different how we apply them, but we can do it under both the perpetual and the periodic inventory systems.